When Genius Failed, The Rise and Fall of Long-Term Capital Management by Roger Lowenstein. Introduction. Imagine a room. It's not just any room. This one is on the 10th floor of the Federal Reserve Bank of New York, a fortress of gray sandstone in the heart of Wall Street. The walls are lined with oil portraits of financial giants from a bygone era, men who look down with stern, unblinking eyes. But on this particular Wednesday afternoon, September 23, 1998, the men gathered here are anything but calm. They are the kings of the financial universe. The heads of Goldman Sachs, Merrill Lynch, J.P. Morgan. Every major Wall Street bank is represented. They are the titans who move markets, who command armies of traders and billions of dollars with a single phone call. Yet today, they are squeezed into cheap, folding metal chairs, because the Fed didn't have enough of its fine, leather-backed ones to go around. And they are here not to bail out a struggling country, but to rescue one of their own from a catastrophe so vast, so sudden, that it threatens to bring the entire global financial system crashing down. The source of this terror? A private investment firm you've never heard of. A tiny, secretive company from a posh Connecticut suburb called Long-Term Capital Management. It had fewer than 200 employees. It managed money for only 100 super-rich investors. It was a ghost, a whisper on Wall Street. But this ghost had a secret. It was run by a small group of academics, a team of professors so brilliant they were called the geniuses. 2 of them had even won the Nobel Prize. They believed they had found the holy grail of investing, a scientific formula to make money without risk. And for 4 glorious years, it seemed they were right. They racked up breathtaking returns of over 40% a year, year after year, without a single losing stretch. But now, the geniuses have failed. Their secret formula has backfired in the most spectacular way imaginable. And in doing so, they've managed to lose more money, more quickly, than anyone in the history of finance. Their firm is a black hole, threatening to swallow every bank in that room. Today, we are going to unpack the incredible story from Roger Lowenstein's masterpiece, When Genius Failed. This isn't just a story about money. It's a timeless human drama about pride, about the intoxicating danger of believing you are the smartest person in the room. By the end of our time together, you will understand a powerful, hidden truth about how the world really works, that no amount of intelligence can ever protect you from the wild, unpredictable, and sometimes devastating force of human nature. Book summary. Every great story of a fall begins with a spectacular rise. And the story of long-term capital management, or LTCM as they were called, really begins with one man, John Meriwether. Now, Meriwether wasn't your typical Wall Street shark. He was a quiet, unassuming man from the south side of Chicago. He grew up in a tight-knit Irish Catholic neighborhood where life revolved around order, discipline, and knowing your place. He was clever, especially with numbers, but he wasn't a prodigy. His real passion wasn't stocks, but golf. He was so good that he earned a caddy scholarship to Northwestern University, his ticket out of the old neighborhood. But Meriwether also had a hidden side. He loved to gamble, but only when he was certain the odds were stacked in his favor. He'd even check the weather report to see how the wind was blowing at Wrigley Field before betting on a Chicago Cubs game. He was cautious, calculating, and he had a poker face that gave nothing away. These traits made him a natural bond trader, and he landed a job at the legendary firm Salomon Brothers in 1974. He arrived just as the sleepy, predictable world of bonds was exploding into a chaotic, high-stakes casino. And it was here that Meriwether had a revelation that would define his entire life. It happened in 1979. A small firm was on the verge of collapse because of a trade that had gone wrong. The trade itself was a form of what's called arbitrage. It sounds complicated, but the idea is simple. Imagine you see two identical items, say, the same model of a sneaker, being sold in two different stores at slightly different prices. Arbitrage is simply buying the cheaper one and selling the more expensive one at the same time, locking in a small, risk-free profit. This firm had been doing that with financial products. They were betting that the tiny price gap between two very similar bonds would close, or converge. But for some strange reason, the gap didn't close. It got wider. The firm started losing millions and was forced to sell. Merriweather looked at the trade and saw the opportunity of a lifetime. He knew, with absolute certainty, that the price gap made no sense. Sooner or later, logic had to prevail. The prices had to converge. He convinced his bosses at Salomon to take over the losing trade. For a couple of weeks, the gap kept widening, and Salomon lost a terrifying amount of money. His boss told him, "We better come out ahead, or you'll be fired." But Merriweather held his nerve. He didn't flinch. And then, just as he predicted, the prices snapped back together. Salomon made a fortune. This moment taught John Merriweather a lesson that he would carve into his soul: spreads always come back. If you are right, and you have enough capital to withstand the temporary pain, the market will eventually prove you right. He had found his life's work. He was put in charge of Salomon's new arbitrage group, and he had an idea that would change Wall Street forever. The traders around him were loud, instinct-driven guys who traded from their bellies. Merriweather wanted to do the opposite. He wanted to eliminate emotion, passion, and guesswork. He wanted to turn trading into a science. So he started hiring a new breed of trader: nerdy, quiet academics with PhDs in math and economics from places like MIT. Wall Street called them quants, and most firms kept them locked away in research departments, far from the real action. But Merriweather put them right at the heart of his trading desk. These guys were different. They saw the market not as a chaotic mess of human emotion, but as a giant, complex system governed by logical rules. They built sophisticated computer models that analyzed decades of historical price data, searching for tiny, temporary inefficiencies, those small price gaps where the market had made a mistake. One of the brightest was a young man named Lawrence Hillenbrand, a socially awkward genius who spoke in precise, mathematical sentences. If a trade started losing money, Hillenbrand wouldn't panic. He would coolly tell his colleagues to double the bet. Backed by their models, they felt invincible. As long as they had enough capital, they believed they could not lose. Merriweather built a protective fortress around his team of professors. They became a family, a tight-knit clan known as JM's guys. They golfed together, took vacations together, and gambled together on everything from horse races to liar's poker, a game played with the serial numbers on dollar bills. Merriweather wasn't just their boss, he was their protector, their patriarch. And he instilled in them a fierce loyalty and a deep-seated secrecy. It was them against the world. For over a decade, this group was Salomon Brothers' secret weapon, generating enormous profits. But their insular, arrogant culture eventually led to disaster. In 1991, a scandal involving one of Merriweather's traders exploded, and even though Merriweather had reported the problem to his superiors, he was forced to resign to save the firm. It was a public humiliation. At 45 years old, the king of bond arbitrage was an outcast. But for Merriweather, this was not an end. It was a beginning. He was bitter, and he wanted vindication. He decided to rebuild his team, but this time, he would do it on his own terms. He would create his own firm, an independent fund that would be bigger, smarter, and more powerful than anything Wall Street had ever seen. He would call it long-term capital management. To launch the most ambitious hedge fund in history, Merriweather knew he needed more than just his old traders. He needed a level of prestige and intellectual firepower that would awe the world's richest investors. He needed mystique. So he went straight to the top of the academic world and recruited two living legends of finance, Robert C. Merton of Harvard and Myron S. Scholes of Stanford. Now, to understand the sheer power of having these two names on your letterhead, you have to understand what they represented. They weren't just professors, they were the architects of modern finance. They were the men who had seemingly turned the art of investing into a science. They developed what became known as the Black-Scholes model, a groundbreaking formula for pricing financial options. In 1997, they would win the Nobel Prize for this work. Their theories were built on a powerful and seductive idea, the efficient market hypothesis. This basically says that market prices are always right because they reflect all available information instantly. Therefore, trying to outguess the market is a fool's game. Price movements are essentially random and unpredictable, like coin flips. But, and this is the crucial part, while individual price movements are random, the pattern of those movements over time is not. They believed prices followed a predictable statistical pattern known as a normal distribution, or a bell curve. Think of the heights of all the men in a country. Most will be around average height, with very few giants and very few dwarfs. The professors believed financial markets worked the same way. Most days would see small price changes, and catastrophic crashes were like 7-foot giants, extremely rare statistical outliers. This led them to a profound conclusion: risk itself could be precisely measured. The key was a single number, volatility, which is just a measure of how much a price has jumped around in the past. If you knew the historical volatility of a stock or a bond, you could, they believed, calculate the exact odds of it rising or falling by a certain amount in the future. They had, in their minds, banished uncertainty and replaced it with quantifiable risk. For them, investing was no longer a game of guesswork. It was a game of odds, just like poker or blackjack. And if you know the odds, and you have a small edge, you can't lose in the long run. With Merton and Scholes on board, LTCM was no longer just a hedge fund. It was, as one partner put it, a financial technology company. They had, in their own words, the best finance faculty in the world. They went on a global roadshow, pitching their fund to the world's biggest banks, corporations, and even foreign governments. They promised returns of 30 or 40% a year, with seemingly no risk. How? By making thousands of tiny, uncorrelated arbitrage bets all over the world. Even if one trade went wrong, the others would balance it out. The diversification was so perfect, they argued, that their portfolio was like a beautifully engineered machine. And they had another secret weapon: leverage. As we talked about, leverage is like using a seesaw to lift something heavy. It multiplies your power. By borrowing massive amounts of money from banks, LTCM could turn a tiny profit of a few cents into millions of dollars. And because of their superstar reputation, banks were tripping over themselves to lend them money on the most generous terms imaginable. Most borrowers have to put down a little bit of their own money as collateral, a sort of security deposit called a haircut. LTCM was so powerful, they convinced the biggest banks on Wall Street to lend them billions with zero haircut, no security deposit at all. They were playing with the house's money, and they could borrow almost without limit. In February 1994, Long-Term Capital Management opened for business with $1.25 billion, the largest startup in hedge fund history. And right away, the gods smiled on them. A surprise interest rate hike by the Federal Reserve sent bond markets around the world into a tailspin. Less experienced investors panicked and started selling everything. This chaos was a gift for Merriweather. As panicked sellers ran for the exits, the price gaps between similar bonds, the spreads that LTCM fed on, widened to absurd levels. While other funds were losing hundreds of millions, LTCM calmly scooped up these mispriced assets, confident that the spreads would, as Merriweather always believed, snap back. One of their first big trades was in home mortgage securities. They used complex models to predict that these securities were far too cheap, and they bought billions of dollars worth. Another huge win came from Italian government bonds, which were trading at a steep discount because traders feared Italy's chaotic politics. LTCM's models said this fear was irrational. They bet big on Italy, and the trade paid off handsomely. The results were simply astounding. In its first full year, 1995, the fund returned 43% to its investors after the partners took their massive fees. The next year, 1996, it returned another 41%. The profits were so enormous, and so unbelievably consistent, that it seemed they had truly created a money machine. They weren't just beating the market, they were operating in a different universe, a universe governed by the cool, clean logic of mathematics. In 1996 alone, this small group of 100 or so people earned over $2.1 billion in profit, more than McDonald's, Disney, or American Express. Their success bred an incredible arrogance. They treated the big Wall Street banks who financed them with disdain, squeezing every last penny out of every deal. They were notoriously secretive, refusing to share any information about their strategies, even with their closest partners. They had come to believe their own myth. As one of the partners once asked a friend, "Do you know why we make so much money? It's because we're smarter." But as their capital swelled to over $7 billion, a problem emerged. The world was running out of obvious mistakes for them to correct. The easy money in bond arbitrage was disappearing as competitors with their own computer models piled into the same trades. The spreads were becoming razor-thin. So, like an army that has conquered all the known territory, LTCM had to push into new, unfamiliar, and far riskier frontiers. They started betting on the outcomes of corporate mergers, a field they knew nothing about. They moved heavily into stock markets, making huge bets on pairs of related stocks, like Royal Dutch and Shell. And they made their biggest bet of all on something called equity volatility. This was the purest expression of their core philosophy. Remember how they believed that market volatility always returns to its historical average? Well, in early 1998, with turmoil brewing in Asia, investors were nervous. They were paying a high price for financial insurance in the options market. This drove up the implied volatility to a level the partners considered ridiculously high. So, they became the world's biggest insurance salesmen. They sold massive amounts of options, betting that the market's fear was irrational and that volatility would soon fall back to normal. They were so dominant in this trade that one bank nicknamed them the Central Bank of Volatility. By the end of 1997, they had so much capital they couldn't find enough places to invest it. So they did something shocking. They forced their outside investors to take back $2.7 billion. But they didn't reduce their own massive positions. This single move dramatically increased their leverage. The partners were so confident, so convinced of their own genius, that they effectively doubled down, betting their own billion-dollar fortunes at the moment of maximum risk. The stage was set for the fall. The end came with a speed and violence that no one, least of all the geniuses in Greenwich, could have imagined. The trigger was a country on the other side of the world, Russia. Throughout 1998, Russia's economy was in a death spiral. But investors, including LTCM, kept pouring money in, convinced by a simple, comforting cliché: nuclear powers don't default. They believed the world's financial powers would never let Russia fail. On Monday, August 17, 1998, the unthinkable happened. Russia defaulted on its debt and devalued its currency. The financial loss from Russia itself was significant, but that wasn't the real damage. The Russian default shattered something far more important: confidence. It punctured the belief that there was always a safety net. Suddenly, investors everywhere were struck by a terrifying thought: if Russia can collapse, anywhere can collapse. A wave of pure primal fear swept across global markets. It was called the flight to quality. In a panic, everyone wanted to sell anything that carried even a hint of risk: corporate bonds, mortgages, emerging market debt, and buy only the safest asset on planet Earth: U.S. Treasury bonds. This was the perfect storm for long-term capital. Remember their basic trade? They bought riskier, less liquid bonds and sold safe Treasury bonds as a hedge. They were betting on the spreads, the price gaps, to narrow. But now, in this global panic, every single one of those spreads exploded in the opposite direction. Their models had told them this was impossible. The trades were supposed to be uncorrelated. A loss in the mortgage market shouldn't have anything to do with a loss in Danish bonds or a merger in the United States. But their models had missed the single most powerful force in finance: the human factor. In a true panic, all correlations go to 1. When fear takes over, people don't think about statistics, they just sell everything they can. On Friday, August 21st, the dam broke. As Merriweather and most of the partners were on vacation, their portfolio began to hemorrhage money from every direction at once. A single corporate merger they had bet on collapsed, costing them $150 million. Their massive bet on swap spreads went catastrophically wrong. By the end of the day, long-term capital had lost an astonishing $553 million. In one day. It was 15% of their entire capital. The partners rushed back to their Greenwich headquarters, their faces grim. Their models, which had predicted they were unlikely to lose more than $45 million on their worst day, had failed them completely. And this was only the beginning. The crisis fed on itself. As word of LTCM's troubles leaked out, rival traders on Wall Street smelled blood in the water. Knowing LTCM was huge and desperate, they started intentionally betting against the fund's known positions, a predatory practice known as front-running. They drove prices down further, squeezing the life out of the wounded giant. Merriweather and his partners were now in a death spiral. Their capital was vanishing, which meant their leverage was skyrocketing to terrifying levels, over 100 to 1. They were so big they couldn't sell their positions without crashing the market even further. They were trapped. They made a frantic series of calls, trying to raise new capital. They called George Soros. They called Warren Buffett. They called every major bank, pleading for a lifeline. But no one wanted to catch a falling knife. The aura of invincibility was gone. They were no longer geniuses, they were just another failing fund. By the third week of September, they had less than $1 billion left. Their clearing broker, Bear Stearns, delivered an ultimatum: if your cash reserves fall below $500 million, we will cut you off, effectively putting you out of business. The end was near. It was at this moment that the Federal Reserve, fearing a systemic meltdown, stepped in. They didn't want to use public money, but they knew that if LTCM failed, it would trigger a chain reaction of defaults that could cripple every major bank on Wall Street. And so we come back to that room on the 10th floor. On September 23rd, the Fed summoned the heads of Wall Street to an emergency meeting. They laid out the horrifying truth. LTCM was about to collapse, and the bankers in that room, the very ones who had recklessly lent the fund its billions, were facing catastrophic losses. The Fed's message was clear: you all created this monster together, and now you must rescue it together. After hours of tense, angry negotiations, with the titans of finance arguing over who should pay what, they finally cobbled together a $3.6 billion bailout package. 14 banks agreed to inject new capital in exchange for 90% ownership of the fund. The geniuses had lost control. Their dream of a financial empire built on pure reason was over. They were forced to hand over the keys to their kingdom to the very people they had once looked down upon. In the space of 5 weeks, they had lost nearly all of their personal fortunes and, more importantly, their reputations. The firm that was too smart to fail had failed in the most epic way imaginable. Commentary. So, what do we take away from this incredible story? It's so easy to look at the partners of LTCM and just see greed or arrogance. And certainly, there was a lot of that. But I think the real lesson here is something deeper, and far more relevant to all of our lives. The story of long-term capital management is a modern-day Greek tragedy. It's a story about hubris, the dangerous pride that comes from believing you are smarter than everyone else, that you have figured out a system that no one else understands. The partners at LTCM weren't stupid, they were objectively brilliant. They had Nobel Prizes and PhD.s. But their brilliance became their blind spot. They fell in love with their models. They believed so deeply in the elegant, rational world described by their mathematics that they forgot the world they were actually investing in, a world driven by messy, irrational, and unpredictable human beings. Their models were based on history, on the assumption that the future would behave like the past. But history, as Mark Twain supposedly said, doesn't repeat itself, but it often rhymes. And sometimes, it throws a completely new verse at you. The Russian default was that new verse. It was an event so far outside the bounds of their historical data that their models simply broke. In their world of bell curves, it was a 10 sigma event, something so statistically rare it shouldn't have happened in the entire lifetime of the universe. But it did happen. And when it did, they discovered the most important lesson in all of finance. In a crisis, all the complex math in the world doesn't matter. The only thing that matters is raw, human fear. For you, as you start your own journey in life, whether it's in business, science, or the arts, this story holds a powerful warning. It's a warning against the illusion of control. It's easy to believe that if you just have enough data, enough intelligence, or a perfect plan, you can eliminate risk. But you can't. The world is, and always will be, uncertain. Life always has fat tails, those extreme, unexpected events that can change everything in an instant. The real wisdom isn't in trying to predict the future. It's in building a system that is robust enough to survive the future you can't predict. It's about humility. It's about understanding that you might be wrong, and preparing for that possibility. The partners at LTCM used so much leverage that they left themselves no room for error. A single serious mistake was enough to wipe them out. So, as you build your own life and career, remember the geniuses of Greenwich. Remember their spectacular rise and their even more spectacular fall. Let their story be a constant reminder to stay humble, to respect the power of uncertainty, and to never, ever believe you are too smart to fail. That was the story of When Genius Failed by Roger Lowenstein. We've journeyed through the dizzying heights and the devastating lows today, but I'll be honest with you, a summary can only scratch the surface. The real power of this book is in the details, the personalities, the tense conversations, the tick-tock of the crisis as it unfolds. It reads less like a business book and more like a financial thriller. If anything we've talked about has sparked your curiosity, I truly encourage you to grab a copy. Reading it isn't just about learning financial history. It's about understanding the timeless flaws of human nature that echo in every field of life. You can find a link to the book in the description below. Also, if you found this summary valuable and it gave you something to think about, please do me a small favor and hit that subscribe button. It lets me know that these stories matter, and it ensures you won't miss our next exploration into another one of the transformative books that have shaped the minds of the world's most successful people. Let's keep learning and growing together.